Well guys, even though the stock market is down almost 30% from its all-time highs, it seems like some folks still think that the worst is yet to come. Now, although in the short term that could make some sense, predicting a further 50% drop from current levels in the NASDAQ is an extremely bold bet. And it certainly goes against everything that successful long-term investors like Warren Buffett have told us. So in this video, I'm going to react to such a prediction made by some fellow YouTubers and discuss what exactly it could take for this bold prediction to be right and what it'd take for them to be wrong. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already.
This is this chart that people will see in markets. The stocks go up. Everybody's like, "Oh, damn, I missed out. Oh, this is I can't miss here. Oh my gosh, what's going on? Nope, we were wrong. We were wrong. It's going back up again, and then the crash." I think we're here. I think we've just come over this mark, and we had that rebound recently where stocks rebounded in March or so, February, March, started to go back up. I think we're here. Am I going on a limb by saying that? I am. But guys, you look at every reliable long-term metric: price to sales, 10-year cyclically adjusted PE ratio, Warren Buffett's favorite, stock market GDP ratio. They all scream not only overpriced, massively overpriced. I believe, mark my words, this is May 5th, 2022. Happy Cinco de Mayo. I think stocks fall 50% from here or more. That sound ridiculous? Fine, it sounds ridiculous. But guys, this is where valuations stand right now. Valuations stand where the next 10 or 12 years has an expected negative return after dividends. So if you have a negative 2% return after dividends, that means you're going to get about a negative 3 or 4% return of prices over the next 10 or 12 years. That means 10 or 12 years from now, stocks will be about half where they are today. Sound ridiculous? Go back to 2000. Go back to 1966. Go back to 1928. Go back to every major bull market, and this is worse than even 2000. The valuation levels today are worse than 2000 in almost every metric except for cyclically adjusted PE ratio, for 10-year cyclically adjusted PE ratio. Does it sound like doom and gloom? It's not. I'm encouraging you, the world will still go on. I'm not doom and gloom. I just react to valuations. And when stocks are 50, 60, 70% lower, I'll tell you guys, now is the time to buy. And people out there will tell me, "You're crazy, stocks are dead." That's what we need to hear. A good friend of mine, somebody I trust very much, said to me, "Paul, I believe the carnage will be over when people give up on Apple." Because Apple is kind of like the last one that everybody believes in. Warren Buffett believes in it. Everybody believes in it. When people have given up on Apple, that's when we're close to a bottom. Because that's when people will say, "I didn't want to own Apple. Let's just go back to our mutual funds, our ETFs, etc." But guess what, guys? If you're living paycheck to paycheck and you're worried about all of this, this is a good wake-up call for you. Sit there and think today, can I afford to have 50% drop in stocks? If you can't, adjust. If you cannot, then just adjust. You can always save more money starting today. You can always work on being more calm starting today. You love discounts on your favorite. Think about the favorite thing in the world to buy, whether it's go out to eat, buy clothing, whatever the thing you like to buy the most of, stocks should be looked at the same way. If all of a sudden your favorite clothing fell in price 80%, would you buy more of it? Of course you would. Your favorite shoes fell 80%. Would you buy more of it? Of course you would. That's the way you have to look at stocks. If the stocks that make sense fall, which they will fall still, even the stocks that make sense today will still probably fall if the markets fall 50 to 70%, you should look at it as, I need to buy more. It's no coincidence that in the long term of stock markets, this is how the stock market goes. I've drawn this graph in 1,000 videos. This is the long-term value of stocks, but this is what actually happens to stock prices. It still goes up, but it goes up like this. Your job is to constantly buy along the way. You're going to overpay and you're going to underpay. And over long periods of time, you're paying this. It's too hard to time the market. It's way too hard to time the market. So your job is to buy every single month, day in and day out, and not worry about it. Especially the further off you are from retirement. If you're 10, 20 years away from retirement, just keep saving, or more, just keep saving every single month. If you're close to retirement, 3, 4, 5 years, make sure you don't have too much. Make sure you do not have too much exposure to stocks, because the next 5 years, I believe, are going to be rough. Now, could I be wrong? Absolutely. I was wrong 5 years ago. I was saying the stocks are overpriced massively back then, and I was wrong. Well, I wasn't wrong, but the market showed me that I was wrong. I think stock prices will go down further than they were 5 years ago. That's just the way I view the world. I view the world based on valuations. I believe the Warren Buffett mantra that in the short run, stocks are a voting machine. In the long run, stocks are a weighing machine. What does that mean? That means that in the short run, the most popular ones that get everybody behind them, all the retail investors, your neighbor's kid next door who's 18 years old and loves Bitcoin and loves Tesla and all these things, they're going to bid up these stocks because that's a voting machine. But in the long run, people are going to care about valuations. And when people care about valuations, they care about them rather aggressively and rather quickly.
So we clearly have a lot to unpack here, but I want to first go out on a limb and discuss the very first comment that Paul here made, which is the fact that we're in a bigger bubble than we were in the dot-com crash of 2000. So to verify that claim, let's actually pull up the NASDAQ and look at it from a technical standpoint. Here's a chart of what the NASDAQ did from 1998 all the way up to 2013, which is a time period between the dot-com bubble and the Great Recession. And as you can see, the prior low that the NASDAQ made before it rocketed higher during the dot-com bubble was sitting around 1500. Whereas obviously the high of the NASDAQ at the very peak before the massive crash was 5,000. So if you do the math, that comes into around a 333% move in the NASDAQ from 1998 all the way up to the early 2000s. However, if we now compare this to what happened from 2020 all the way up to 2022 and compare the low of March of 2020 to the peak of the NASDAQ in November, as you can see, that move falls into around 149%. So simply off a technical basis, the NASDAQ is nowhere near to the levels of severity we saw in the dot-com bubble. However, let's give this guy the benefit of the doubt and look at the valuation metrics of the market instead of simply the technical standpoint. Well, as you can see, even if you look at the PE ratios, back in the dot-com bubble, the S&P 500 was trading at PEs of almost 25 to 26. Whereas today, we're only trading at PEs of around $16 to $17. And the even crazier part is that on small cap growth stocks represented by the blue and green lines, we are trading on levels at par with 2008. So the idea that valuations are extremely high and bigger than what we saw in the dot-com bubble simply makes no sense. And to be completely honest, one of the things that this guy seems to be missing on is the fact that earnings continue to grow in US stocks on a very consistent basis over the past 40 years. And so as companies become more profitable, the natural valuations that investors are willing to pay for those companies also go up. So if you compare what happened in 2001 and 2020, the valuation should technically be trading at a much higher value given the earnings growth we've seen between that time. But I'm not even going to leave it there. To really put into perspective the big claim this guy is making about the NASDAQ dropping another 50% from the price levels that we're seeing today, this is the pricing that we would have to see on the NASDAQ, which equates to the price we saw at the end of 2018. Now, is this completely possible? Sure, because anything can happen in the stock market. But probabilities wise, this is a very low probability kind of event, because as you can see, this same argument about the market having continued in a spiral downtrend could have been made during this dip, during this dip, and during this dip. And so maybe you should ask yourself and understand what is different this time. And to be completely honest, from an underlying economy and earnings growth standpoint, these stock prices are still very cheap. And it's a very unsustainable amount of selling because obviously interest rates in the long term don't really affect corporate businesses that much. And as we all know, big money, institutional investors, hedge funds, and media outlets like CNBC are inherently designed to make retail investors lose money by either not buying the dip during corrections or by buying the tops. And so I really feel like during corrections and periods of turmoil like this, we should actually really promote buying the dip and staying disciplined to your strategy. Because at the end of the day, it's patience and respecting your strategy that really rewards investors. And that is the same thing that somebody like Warren Buffett has applied to build his wealth. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on what Paul said in this video. I would definitely be very interested in hearing your guys' takes. But anyways, guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.